Welcome to the More Time, More Money and More Wealth mini podcast for business owners, brought to you by Wow Advisors Group. This podcast is dedicated to business owners who would like to work smarter and not harder, earn significantly more income and create astonishing wealth. Now, let me introduce you to our host today, Hitesh Mohanlal.
Hello and welcome to podcast number 12 of the Wow Advisors Work Less, Earn More and Create Unbelievable Wealth podcast. And as you can see, we're in a slightly different environment today, and that's because actually I'm on annual leave. This podcast was recorded a few days ago, but due to technical issues, we wouldn't be able to put it out, so I'm re-recording it, if you like. So that's why the different background and the different environment. But what are we going to talk about today? Well, we have to talk about this budget, and I know you're thinking, but it was 2 weeks ago, life's moved on, we kind of know what's happening, and I think it just needs a bit of explanation, especially on those three parts that have been significantly changed. Okay, now there's a lot of anger out there on the budget. If you go onto social media, there's lots of people who are saying people are going to leave Australia and the government's nonsensical and it's done the wrong thing and it's attacking all these people. And some of that may be true, some of that may not be true. If you have read my blog that I put out the day after the budget, you might have got the impression that I was quite angry too, and to a certain extent I was, but it's not totally what I would call the end of the world, if you like. Okay, yes, there's some parts which are or should be subject to anger, but there are some parts which actually do make sense. Okay, but the reason I am particularly angry is normally when a budget comes out, I ask 3 or 4 real questions. Number one, will it help the country grow? Number 2, does it bring the tax burden down for a majority or all of the citizens of our country? Number 3, does it make the tax system easier? And number 4, will it make your life easier? Okay, and when you list those 4 things down and try and answer them, in most cases I get the answer, which is no. Okay, the tax system has actually become more complex. It's actually going to cost you more money to deal with this stuff. So it's failed miserably on that account. Has it made the tax system easier? No, it's made it more complex. Okay, so people like myself have got to get involved and deal with things that I would rather not deal with, and give actual advice on how you can make your business better. So it fails miserably in that part too. Will it make the company, the country grow? Maybe. Okay, when you look at the tax amounts that are going to be collected because of this, yes, the country is going to collect more money or collect more of our money. Question is, will they spend it wisely? And I'm not convinced this government will spend it wisely. So if you look at those criteria and what a budget should do, I'm not convinced it's going to work for us, and that's where part of my anger comes from. And I genuinely believe a government's job is to educate its subjects so that they can live a better life. And really, to become wealthy, you need a plan, not necessarily a tax system. So that's that. Okay, let's get to the 3 major parts that have affected a lot of people. Okay, the first one is negative gearing. Okay, now actually I don't have a problem with the negative gearing rules, and the reason I don't have a problem with negative gearing is because negative gearing encourages people to actually keep loans and make losses. So let me first explain what negative gearing is. Negative gearing is when you have, say, an investment. So for example, a investment property, and that investment property has more expenses than income. So the expenses are more than the rental income coming in. Okay, so you made a loss on the property, and what the current tax rules say is if you've made a loss on this particular property, what you can do is you can set it off against your other income, so your employment income or anything like that, and that results in a tax saving for you. And what the government's basically saying is, why should you get a tax saving because you've invested, but anyone who buys a property and lives in it doesn't get a tax saving? That is unfair. And to a certain extent, I agree. I don't necessarily disagree with that. Okay. Also, because, like I said, if you are in a negative gearing position, because everyone says this is great for tax, this is great for tax, this is great for tax, people don't pay their loans off and try and keep the property in a negative geared position because they think they're going to be better off under taxes. And you might be better off under taxes, but that doesn't necessarily create wealth. The way you create wealth is your asset values go up. If your loans go down, you have more asset value, and therefore you become more wealthier. Whether you reuse that equity to buy something else, you're creating more wealth. So that works too, but just keeping the loan because you think you're going to get a tax advantage doesn't necessarily work. So for me, the negative gearing changes that they've come up with, I actually don't have a problem with. So what are the changes? The changes basically are is if you had a investment property and it was negatively geared at the time the budget happened, which was 12th of May, anything bought previous to that, the rules don't change. You can still negatively gear your property, okay? And that will continue until you sell that property, okay? The next one is, let's say you buy a property now, post 12th of May, up to 30th of June 2027, what they're basically saying is until that period of time, you can negatively gear that property, okay? But after 30th of June 2027, you cannot, so you'll lose the negative gearing. Okay, anything purchased after 30th of June 2027, no negative gearing at all. All right, so that's the negative gearing rules. And as I said, I don't really have too much of a problem with that. Then we come to the capital gains taxes. Okay, and that's a bit more controversial, if you like. And what they've said is this part makes the tax code more complicated. Okay, because what they've said is the 50% discount. Now, in my books, the 50% discount was simple to calculate, easy to understand, and it worked. Didn't really need to be messed about with. Okay, but what they've done is they've said, right, from from 30th of June 2027, the 50% discount no longer can be used. And instead, what we're going to have is something called indexation. Okay, so prices go up sort of every year. It's called the Consumer Prices Index, and that's basically indexation. Okay, and what they're saying is basically will allow you to have that part, but anything above that, you will end up paying taxes for. So, for example, if indexation came to 3%, and house prices go up 10%, then that 7% extra increase, that's what you're going to be paying taxes on. Okay, so what have they said? Again, existing properties, they've turned around and said no change on that one. Okay, all right, up to 30th of June 2027, and then after 30th of June 2027, you've got to apply indexation. And what that has now done is it's made the tax code exceptionally complex, because it now means if you sell a property post 30th June 2027, which you owned or have owned for a number of years, when you do sell it, you've got a dual calculation. You've got a calculation which is 50%, and then you've got a calculation of indexation. And we accountants are going to have to sit down and do it. It's going to take us longer because it's complex. The tax return becomes more complex because it will want more information. And then that results in you paying higher fees because there's now additional work to be done. Okay. The other thing is it's going to make a complete industry of valuations, because what the ATO is saying is you basically need to know what the value was at 30th of June 2027, okay, in order for the indexation to apply. And there's been a lot of commentary in our industrial in our industry in terms of what do we do? What do we tell our clients? Do we tell them to go out and get valuations at 30th of June 2027? And that sounds all very simple, but someone's got to pay for it. And if you've got 3 properties, then 3 valuations is going to cost some serious money. Now, there is a lot of people who are saying, go out there and get your valuations done, or at 30th of June. There will be some who say, look, you don't need to get valuations done on 30th of June because 500,000 people are going out there trying to get valuations and pricing is going to go nuts. What you can do is just get the valuation done when you sell. So you can get professional people who can go and backtrack valuations at 30th of June 2027. As to which way you go, we will leave that up to you. We know what we will be telling our clients to do, and we will speak to them on an individual basis depending on their circumstances. All right, so that's for existing properties. For properties purchased between now and 30th of June, again, you've got this dual calculation that will happen. Anything post 30th of June 2027, there is, you basically just use indexation. All right, then the next part, and again, this is the controversial part, what they've turned around and said is any capital gain that's made post 30th of June 2027 is going to be taxed at a flat rate of 30%. I'm not necessarily convinced that's a great way to do it, and I'm not sure where they came up with the figure of 30% or why, but basically it's a flat rate 30%, and that's going to result in more capital gains tax being paid by ordinary investors. Okay, and I'm not necessarily convinced that's a great thing to do. So that's the changes to capital gains tax. Then we have the most controversial part of this budget, which basically says if you have a trust and that trust makes a profit, then that profit will be taxed at 30% irrespective of anything else. So a minimum rate of 30%. So what it basically means is the trust pays 30%, and if you're a 45% taxpayer, you'll end up topping up 15%. If, however, you're like my son, who's 19 years old, still at uni, hasn't got a full-time job, if he gets a distribution from a trust, he will have to pay 30% minimum tax on that. But if he didn't get that, but he got it by working at McDonald's, he would pay 0% tax. And that's why everybody's really upset about this particular change, because what they're saying is this doesn't make sense. And I'm in total agreement. It does not make sense. Income is income. So you should always have income in the scales that you want. This again makes the tax code more complicated, okay? And it's not, as I said, it's not necessarily for the beneficial interest of anybody, to be quite honest. And what the reason I feel that this government has done that is because they've come to the conclusion that anybody who has a trust, and trusts have boomed in the last 20 years, the number of trusts that are in existence, and their view is people set up trusts to basically save tax. And I can tell you categorically that is not true. A lot of trusts are set up for completely different reasons. Yes, tax will play a part, but it doesn't necessarily play a big part, okay? So for example, we tell a lot of clients that for their estate plan, for their wills, they should consider testamentary trust, because those trusts in a will protect that income. It will ensure that young children don't all of a sudden get hold of the money and then spendthrift it or spend it. It ensures it might be protected over, say, other loans or bankruptcy or even divorce, okay? And those are the conversations we're having. The tax barely makes a mention in it, okay? There are lots and lots of businesses in Australia that operate through trusts, not to save tax, but again, it's an asset protection and an entity thing, all right? But this government's got it in its head that anybody who's got a trust is doing it for tax purposes, and they've said, oh look, if you don't like these new rules, you can change and move to a company. And that sounds really brilliant, and I would love that if all I had to do was write a letter to the ATO and say, hey guys, we're moving our client from a trust to a company. It's not as simple as that. Okay, generally reconstructions can cost anywhere between 10 and 15,000 just in legal and accounting fees. All right, then you've got stamp duty, because what you're doing is you're selling your trust to a company, and that involves capital gains tax. And the ATO is saying, look, we'll ignore the capital gains tax, but the stamp duty, I can't see Queensland government, New South Wales government, Victoria government turning around and saying, oh, you know what, we'll help you out and we won't ask for the stamp duty. They're going to ask for it and they're going to want it. We had a client in just last week, and we were looking at restructuring their business because of what the budget was saying, and we worked out that the stamp duty alone was about $100,000. My client doesn't have $100,000 stashed away on the side so that they can pay the government or the state government stamp duty of $100,000. So we're in a bit of a quandary as to what we do. So that's what they've done on the tax side, and I think the reason there is a lot of anger is because what the government is basically saying is don't invest, or is discouraging investments. Okay, and I don't necessarily believe that. In fact, it goes against most wealth creators. If you coaches and people who really know how to build wealth or have done, they will say that's exactly the opposite. If you want a country to grow, you must get your citizens, you must get your subjects to actually invest, because that's what brings the country up as a whole. All right, so I do have some real issues with that, because if I've got a young person sitting in front of me and I'm advising them, I'm really saying to them, you want to do investments because that's where your long-term wealth is going to come. But I'm now going to have to say to them, but you're going to have to pay 30% tax on that, whereas if you went and worked somewhere, you won't have to pay any tax on that. And they're going to turn around and say, well, why would I want to invest? And that's where I think that the problem's going to come out. And I just feel that the way they've justified it is that, and they're justifying it by saying house prices will come down if we do this. And we've heard over the last couple of weeks of clear out rates of auctions and pricing becoming a bit tighter. Yes, that will happen, and that's simply because people are uncertain right now. They don't know what the rules mean. They haven't sat down with their accountant. They haven't spoken about it, so they're not sure what to do. So they're backing off at the moment. But people like me will still tell my clients, okay, the tax rules aren't so beneficial right now, but still invest, and they will get back in the market, and the pricing will still go up. Will this solve the pricing for housing? I don't think so. We're just not building houses, and that's the problem. It's got nothing to do with taxes. Okay, so those are the three major changes. What does it mean for you? What does it mean for most business people? What does it mean for anybody who's invested? I will tell you it means a couple of things. Number one, you're going to have to sit down with your financial planner or your accountant. It's not an option. You have to do it. Okay, you have to sit down and say, how does this affect me? In one of our classes, we've actually told some clients to get out of the market in some cases. We've told others to hold on. Your personal circumstances will determine which way you go. So have a look at that. All right, you're going to have to sit down with someone. You're going to have to pay someone to give you advice, and this is why I'm saying this budget is not great. You should not have to pay me to tell you what's happening from a tax perspective in your investments, in your business. What I should be doing to you is telling you how to work less, build wealth, and how to build an income. All right, and because people are now going to have to pay me to advise them on what the budget means, they might not have the funds to really get the advice that they really want, and that's probably my biggest fear and my biggest anger. But that's my view of the budget. That's what I think. But I hope what I have told you today is useful for you. Thank you very much. Have a great day.